Thanks very much, Ross. Great to see you. Do you think that's one reason why investors seem reasonably calm about the impact of these tariffs? I mean, it's hard to read people's minds. People see it maybe as just bluster and negotiating maneuvers by Mr. Trump?
Yeah, I think so. And I think that, the lesson from the first Trump term is twofold. One, there is a lot of public negotiation with tariff threats being used, not just to, exact concessions on trade, but on other parts of the socioeconomic spectrum, whether it's, immigration or fentanyl. And so that when, a deal is made, those tariff threats get pulled back. And then two, even with the tariffs that were levied in the first trade war in 2018 and 2019, the market continued higher, earnings continued to grow. There was a bit of an offset from the impact of tax cuts and deregulation and some of the more pro-growth policies. So I do think that the market's, sanguine approach so far has a lot to do with both of those things.
Because, it would be very damaging to U.S. industry. I know the boss of Coke said today, well, 25% tariff on aluminum for our cans. It's not the end of the world. But for automakers, the Ford CEO seems really worried.
Yeah, I think this is the kind of where active management and individual sectors and industries matter. For the equity market writ large, especially, a cap-weighted one that's primarily concentrated in big tech, maybe not the most impactful thing in the world, a tariff on metals. But for certain industries and certain companies, obviously can be very damaging. Now, we know that even if tariffs are levied, maybe some of it gets absorbed with currency moves. Maybe some of it comes from, discounting from the exporter. But obviously, ultimately, some of that is going to get passed on to the final consumer. And, the consumer has voted with their dollars. And at the polls, they do not like inflation. So I think if it does start to show up in price inflation, President Trump and the Trump administration may have to reconsider some of these tactics.
We're into the third year of gains for the U.S. stock market. I mean, the market is up this year. What's your playbook right now, Ross?
Yeah, I mean, there's a lot of noise coming from, Washington as the new administration gets settled and starts to enact some of their policies. But I do think that all of the focus on Washington obscures what are the fundamental drivers of this bull market that we think we're still, in the middle innings of, which is a strong consumer, driven by both a solid labor market and just significant wealth accumulated, whether it's in the form of home equity or, stock markets at records or quite frankly, just strong disposable income growth. And it's driving earnings. So we've seen price multiples expand, but now we're really looking forward to strong double-digit earnings growth in 2025 and should keep this bull market going. So I think there's a lot to like about the bull market from a fundamental perspective that does tend to get obscured by all of the machinations out of D.C. and on the geopolitical front.
What about AI names? Maybe start off with the chip names in general. You're inclined to buy them on a pullback right now. You do see strong growth ahead for that area of investment. Yeah,
I think you still want to be buying the chips and the semis on weakness at this point in the AI cycle. I think we're still pretty early days. The infrastructure still needs to be built out. Even if you have, the DeepSeek that kind of challenges whether all of this spending is necessarily good ROI, there still is clearly a base that needs to be built up if the AI theme is going to be as impactful as most think it will be. So I think you can buy those names on weakness, and then I think you start looking for downstream winners of the AI trade, the companies and the sectors that will most benefit from a productivity boom that, a really successful AI chatbot or AI assistant could bring. So I think you're still in the stage of the trade where you can buy the picks and shovels, buy the infrastructure, but pretty soon we'll shift to, where the software starts to get built out and you start to see the apps and the winners that actually, raise the productivity across all industry, not just within the tech sector.
What about the fact that the Fed is stubbornly, it seems, refusing to bring down interest rates right now? Jay Powell was a bit of a sourpuss in this testimony to Congress. Seems fine with rates as they are right now.
Yeah, I might quibble a little bit. We have inflation under 3%. You have, housing starting to weigh. I do not quite understand the hesitation to at least get back to a neutral policy rate, even if that's somewhere between 3 and 3.5%. But you do have to play the ball as it lies. obviously higher for longer interest rates is a theme that we would expect to see this cycle, regardless of whether the Fed cuts 2 or 4 times in 2025. I think the big thing for investors to remember is that while a quick move higher in rates might be a tactical risk to the market, you could look at something like the 80s and 90s. If we want to compare this to the 90s, the Fed funds rate and the 10-year were much higher than they are now for most of that run, where growth stocks and tech still worked quite well for most of those 2 decades. So high rates in and of themselves are not a death knell for equities, but I do think it means you have to focus on quality stocks and quality names and not companies that are expected to be profitless into perpetuity.